Hello, everyone. Thank you for joining us today. I see our participants starting to come in. My name is Mark Reese, and I will be helping Randy and Harkrishan today in our webinar. I also want to point out, please don't worry about what you're seeing on screen right now. This is just something we want to bring attention to shortly, but you are in the correct webinar for the Cost Segregation 179D and 45L. So we're just going to wait a couple minutes to make sure we get everyone in. But in a moment, I'll introduce Randy and he'll go over some of the housekeeping rules and we'll get started shortly. Give it another minute or so.
And since I can't sit and be quiet, I just, Mark mentioned this first slide. This is really exciting. We are going to have our second annual virtual conference at the end of this year, November 30th, December 1st. Take a look at the list of speakers. You may recognize some or all of those names. I'm very honored that we have this unbelievably strong group of speakers speaking at this conference. As all of our things are, this is free to you. It is high quality CPE that we really enjoy sharing with you. So look for this. We'll have more information in July. Registration should be open.
Well, since we've already gotten started, I'll go ahead and introduce Randy and hand it over. But yes, we're going to be discussing cost segregation, 179D and 45L, and I will go ahead and hand it over.
Well, thanks, Mark. So yeah, Mark said what we're seeing today. What we are doing is CPE presentation. So this is available for CPE. We need you, as we always, to stay logged in for 50 minutes and to answer 3 of the 4 polling questions that will pop up throughout the presentation. Your certificate will be emailed to the address that you registered with, and Mark is getting that process pretty well in shape, but it's probably still going to be next week, early next week, before those certificates go out. If you do have any questions, I will be monitoring the questions as Harry's speaking. I will do the end of the presentation here, but as Harry's speaking, I will be monitoring the questions, and probably during the polls, we'll try to answer any of those questions that I see pertinent. As a double check, just make sure nobody's saying you can't hear me, but in the chat, just say you hear us. You see Harry's slides right now, just to confirm we're good to go on to the presentation. In the chat, please. Nobody's chatting. That's not a good sign. Somebody please say you hear us and see us. Yes, all good. Thank you, Aaron. All right, now, quick introductions. Here's me. Everybody's saying we hear me now, so thank you. I got nervous there for a second. There's me. I'm not the star of the show today. Harry is. He's going to be sharing some pertinent information on cost seg. I will share some 179D and 45L at the end, which there's some cool things happening on that. My background, I'm a CPA, came out of public accounting. I do a lot of talking. I have a podcast. I do webinars. I do conferences. I'm often on other people's podcasts. Listed as one to watch in Accounting Today's Top 100 Most Influential. And the most fun thing that happened in the last week to me is I was recently appointed to Intuit's Tax Council, which is a 3-year term, which I'm really looking forward to. My first meeting is this Thursday. So that's me. Harry, move on. Again, here's the star of the show. Harry will be talking about cost seg. He is our director of cost seg. He has worked on many studies for many different businesses and all different sizes. You can see his certification information. He is a Boilermaker, a Purdue grad. Is that the 2 degrees, construction and transportation, Harry?
It's an emphasis.
All right.
I have a second degree, but it's in entrepreneurship and innovation. So.
All right, and obviously he had to promote goal Boilermakers there. With that being said, I'm going to hand it over to Harry, and I'll jump in when we're doing. Oh, you know what? Let me do this, Harry, real quick. Just let me tell you about Trimerit. We are a specialty tax firm. We support tax preparers and their clients by trying to lessen their tax burden, increase their cash flow on many different areas, cost seg being one of them, 179D, 45L, which are energy incentives, R&D tax credits, work opportunity tax credits, and the employee retention credit. So those are the 6 things we work on. We cover the entire country. We have a very significant staff size that we have really built up in the last 2 years, and with anticipated growth, we are sitting in a really good place right now to handle any new business that comes our way. Now, Harry, sorry, premature start. It's all yours now.
Thank you so much, Randy, for the introduction. Hey, everybody. So today we are going to talk about cost segregation. Before we dive into cost segregation, I always feel like we should cover some basics. At the crux of things, cost segregation is nothing but a depreciation deduction, right? So I found that it's pertinent for us to discuss what the hell is depreciation deduction before we dive into cost segregation. So basically, as per the regulation code 167A, you can, whenever you buy a property, you get a reasonable allowance for exhaustion, wear and tear, basically depreciating any property. IRS gives you an allowance that goes on your schedule as a deduction that you can use. So to claim a depreciation on a property, you must use it in a business, or it should be an income producing activity. And if you use the property to produce income or an investment use, the income must be taxable, and you cannot depreciate property that you solely use it for personal purposes. Meaning, any residential homes where you're living in, you cannot claim depreciation deductions on those. And now, to be depreciable, the property must also meet the following requirements. Number one, the property you must own, right? I mean, you can own a residential home, but you cannot claim depreciation deductions on that. Second, it must be used for your business or income producing activity, and it should have a useful life, and also it should be expected to last more than a year. So once we have cleared this out, what the hell is depreciation, we'll get straight into cost segregation study and what are those. At a high level, cost segregation is nothing but sort of like think of it as like a study done to accelerate depreciation in the first few years instead of taking it over the period of the life of the property. So the whole point people do cost seg is to reduce your taxable income. So if I can save you $1 today, that has more dollar than the dollar tomorrow, right? And in order to do a cost segregation study or depreciate any asset, for a matter of fact, you need to know the asset's place in service date, the recovery period of the asset, the convention of the asset, the property class, and the method, which will, if you know all these things, only then you can accurately depreciate that asset. So the whole point of a cost seg study is to allocate a portion of the basis or a purchase price and minus land, because land is not depreciable, is to allocate it up front so that you can reduce your taxable income and increasing your cash flow so you can invest somewhere else, right? So you're basically timing the money. You're not taking money away from IRS. You're just trying to time the money when you should be getting the money. So if I save you $1 today, that has more value than the $1 tomorrow. So this is just a simple, picture showing what happens in a cost segregation study. So when let's say you acquire property, and after you acquire property, it goes on your depreciation schedule. And that basis we're trying to do is we're trying to allocate a portion of that basis into 5-year, 7-year, 15-year QIP or 15-year land improvements, any repairs, retirements, and the remaining portion moves to 27.5-year residential rental, or if it's 39-year commercial. So that's the exercise that a cost segregation study goes into. Now, I have a brief slide kind of explaining the same thing, what I showed you in that picture. So when a building or a structural component that is there, which is usually the basis of the property, depreciates over 39-year or 27.5 years. So let's say you bought a property and you didn't want to touch it. You didn't want to do a cost segregation study. If it's a commercial property or it's a non-residential, as for the regulations, it will be depreciating over 39-year. But if it's a residential property, it will depreciate over 27.5 years. Now, if you conduct a cost segregation study, the whole point is that basis that you have will be moved to 15-year or 5 or 7 year. But the thing that you got to keep in mind is your longer life property depreciates over a straight line method, and your other property like land improvements depreciates over 150% declining balance, and your 5 and 7 year depreciates over 200% declining balance. Remember in a previous slide we talked about the methods. So these are those methods to which the cost segregation applies to, and they will depreciate it over. So since we are here, kind of told you what cost segregation is, I'm going to start open polling question number 1.
All right, and I will pop that up, Harry, and we will keep going. So polling question 1, I am launching right now. Have you or your client ever conducted a cost segregation study? Polling question 1 is up, and we will leave it up there long enough to get most of you, if not hopefully all of you, answering these questions so that we can get you your CPE certificate. And we're at 85% already. That's great. If you don't need CPE, still vote if you can, so I don't freak out that somebody hasn't voted. Yeah, but you don't have to. I'm not pressuring you on this, but I got 92%. I'm going to leave it up for just a minute. I want to get back to Harry's information, so not just a minute, just a second. So 10 more seconds, and we're going to close this out. You got, we're at 95. 95 is a key number. And here I go. I'm going to close this out, and 72% of you have conducted a cost seg study for your clients or had one conducted, and so that's a pretty significant number. Okay, Harry, back to you.
All right, thanks, Randy. So that's pretty good. A lot of people know what the hell cost segregation study is. So since most of you know, let me just kind of dive into the history and how it became a norm. Cost segregation is not something new. It has been around since the ITC days, which goes back to 1960s. So when ITC phased out, it left a few principles that were transferred, excuse me, to the current system, which is MACRS. And MACRS is also known as Modified Accelerated Cost Recovery System. So which was enacted in 1986, in which gave us two systems. One is GDS and other one is ADS. This presentation is not going to go into, which property apply for ADS or GDS. Just know most of the properties would follow a GDS system unless indicated. There's pertinent rules. Sometimes if you have an asset placed into service outside the US, or, if you're trying to elect into 163J elections, which again, I said, we're not going to go into those details, but just know there are two systems. Usually, cost segregation study follow these systems. And the next slide, I'll talk about when did cost segregation study became a mainstream and when did everybody start to, started doing these studies. So Hospital Corporation of America was the key case which made cost segregation study more important, or people started to know about this because there was a legal support, which for the first time, it gave a legal support to the cost segregation study, and it started to become more widely acceptable. And what happened was the IRS started opposing that you cannot do component depreciation, which means that you cannot segregate 1245 and 1250 property, because they said that it's not permitted under the rules which were post ITC under acres and makers. The tax code ruled it otherwise, saying that, hey, Congress really intended for taxpayers to be able to distinguish between 1245 and 1250 property. And they said that additionally, any assets that are not deemed for general operation and maintenance of the building are tangible personal property. So it actually gave a legal kind of backing to cost segregation. So people started to do it more because now we had a legal ground. And later on, dilly-daddling, IRS came back in 1999 and they released an action on decision saying that, hey, they said that we agree that tangible personal property is defined under the ITC, still remain applicable under acres and makers. So they were disagreeing with it first, but they because court said it, they agreed with it. So this is the main reason why cost segregation is even there today. So going into what are the candidates that are good for a cost segregation study? So if you have acquired a property or you have inherited a property if you newly constructed a property and you're doing interior build out, you're doing renovations, all of them are good candidates. But I'll hold you there for a second. Doesn't always mean that it will make sense still to do a cost segregation study. So you still have to see when was the property placed into service. You know, typically it would make sense to look at the assets if they were placed in service after 1987, because if you go before that, then at that point, if you look at the ITC days, the properties were depreciating over 31.5 years, not 39 years. So it wouldn't make sense. And if this property's asset is placed into service in 1987, more than likely the asset is fully depreciated. So it wouldn't even make sense, right? Second thing is you got to look at when was the assets placed into service. That can even tell you the remaining life of the asset. For an example, if the asset is placed into service 39 years ago from now, more than likely the asset is fully depreciated. It wouldn't even make sense to do a cost segregation study. It might, depending on, you know, when I say wouldn't make sense, I'm saying from the perspective of cost to benefit ratio. A cost segregation study might cost you more, you know, compared to the deductions you'll be getting. So you kind of like time value money that we are selling, it wouldn't make sense to do it, right? And the third point is the remaining depreciable basis that is left in the building. So let's say you bought something for $500,000 over 39 years ago, more than likely there's not enough basis left even for you to look at it. So these are three indicators that you should be focusing on if it makes sense to do a cost segregation study or not. What you see on your screen is basically telling you class lives of different assets where we have done cost segregation studies and what it yield from the result standpoint for 5-year, 15-year, 27.5-year, and 39-year. And I want to, like, this is not a gospel. This is just an average. So that's why you see warehouses, we can see 5-year being 3 to 8%. For 15-year, we're going to be seeing 5 to 15%. And remaining obviously is allocated to 77 and to 82%. So that's the range that I'm trying to give it to you. It can vary, you know, this is not set in stone. But this is just give you a general idea. Hey, if you acquire a manufacturing facility, you can expect getting a higher deduction compared to acquiring a warehouse. That's what we put this thing together to kind of show people, because a lot of times, you know, when we're doing investment tax planning for people, I have a lot of syndicators coming to me. Hey, you know, we have been doing this apartment syndication for a while. I'm looking to invest somewhere else. Let me know which other asset class should I park my money in so I can get more deduction. So this kind of gives you a general outline. You know, if you park your asset in casinos and hospitals or, you know, manufacturing, you will end up getting more depreciation deductions compared to a warehouse, you know, or a store unit, what have you, right? So when you should consider doing a CS study, right? I've seen a lot of practitioners going out there not talking much about this. I know a lot of CPAs talk about this. I know a lot of investors talk about this. I found this very pertinent issue to talk about it because I'm a syndicator myself and I invest passively. So I thought that this is very important for people to know and not just kind of go into a CS study because a practitioner trying to sell you a CS study. So first things first, you got to understand, you got to have enough income to offset those losses created by a CS study, right? And it is a step further that we take a position in Tri-Merit that we're not just trying to sell you things. We try to ask the client, hey, do you even have enough losses? Did you talk to your CPA if it makes sense for you to do a CS study? We kind of work with the clients instead of just putting up proposals, making a sale. We don't work that way, right? So that's number one. We are client centric. We want to make sure if you do a CS study, you pay me a hefty amount. I want to make sure you're getting benefits out of it. That's number one. Number two, any losses that are generated specifically for a rental activity by a cost segregation study, they're always considered passive losses. Now, let me explain that a little further, right? So typically, let's consider an example. If you have a rental activity, if you have an apartment or you have a house, single family home, and you're not materially participating in that, it's a passive activity, right? Because you're not materially participating in it. Now, if you have a W-2 job, or if you have like a business in which you are spending hours, that is non-passive activity, right? So any losses created by a passive activity are passive losses. That means you cannot offset your active income. Means you cannot offset your business or your W-2 income. Okay, but there are some implications there. Until and unless you qualify as a real estate professional status and materially participate in the activity, at that point, you can offset your passive losses with the active income. That is the only way you can do it. Now, what happens, a lot of times I have clients coming to me and they be like, hey, I qualify for real estate. I'm a real estate, professional. I'm like, okay, you're a real estate professional. Do you materially participate? I was like, what the hell is that? So you have to go through the rules of materially participating in the activity, which pretty much means that, let's say, in order for you to qualify the material participation, if you have a W-2 job and you're spending 2,080 hours in the whole year, you have to spend 2,081 hours in your other passive gig in order to be materially participating in that activity. Until you hit that, you're not materially participating in it. So if IRS looks at it, they're ready to catch all of these things where people are just checking a box. Oh yeah, I qualify for real estate professional status. It's not gonna fly. And again, it might seem like I'm giving a CPA advice here, but at the same time, I'm just trying to, be a best advisor or consultant to a client where kind of just talk to your CPA if it makes sense what to do and what not to do. That's material participation, right? And let's say if you are materially participating in some activity, that'll be considered non-passive. So at that point, that real estate in which you materially participate and is under one LLC, that'll be considered any losses generated by the cost seg at that point will be considered active losses, right? And your active income can offset your active losses. Passive income can only offset passive losses. Active income can only offset active losses. So you cannot commingle those, right? Now, there are some implications. There is a way around it. And I'll give you an example. Let's say you have a dental practice, right? The dental practice is parked, is parked under an S corp. And then you have an LLC that's parked, the real estate is parked under the LLC, right? Now, the income generated by this S corp, right, and the losses generated by the cost segregation study from this LLC cannot offset that active income from this S corp because you are leasing. If you're leasing this generally happens. I didn't mention that to you. So S corp, you're leasing this S corp from this LLC in which the building is parked. If you're leasing it, you're paying this rent to this LLC. Income generated from this S corp is an active income, and the losses generated by this LLC is considered passive losses. You cannot offset them until and unless you can consider a grouping election in which it will be considered you can parking this as an appropriate economic unit. In that sense, you can offset those. But in order to do that, there are some implications, and I would always advise to go to your CPA, how you can make a grouping election, talk to them and be like, because it has to be done on a timely fashion and it has to be done at the starting of the year. And there are other implications which I'm not even qualified to give you advice on, but there are rules which you can follow in order to get those elections, in order to consider these losses can offset the active income, but you have to consider that an appropriate economic unit. Now, the third thing that I want to highlight is, if I have some people coming to me, they want to do a cost seg because they invested as a limited partner. If you're investing in a syndication as a limited partner, that's considered a passive activity. That's not an active activity. Reason again, you're not materially participating. You're just getting a paycheck every quarter, every month, in which you're not materially participating. You're not going to qualify for the number of hours that need to be spent, right? And again, same thing, investing in real estate where you don't materially participate is considered passive, and losses generated by a passive activity gets suspended until you have enough passive income to offset. So you gotta have enough passive income to offset your passive losses. You can have other passive income coming from other streams, and you have passive losses generated by one real estate. You can offset it, but you cannot commingle it. Now I'm gonna shift on to next polling questions. Polling question number 2, Randy.
All right, polling question number 2 is coming up. And in the meantime, while that does, you can see the QR code there if you want to scan. It goes to our info@Tri-Merit if you have any questions. So polling question 2 is up. Are you or your client looking to create more passive or non-passive losses? I guess it depends on the situation. All right, well, that's up, Harry. Let me ask you a couple questions that came in. I don't know if we have the answer or not, but first, well, there was a question about ADR, and I'm no expert like you, Harry, but the ADR system, I think, is no longer in place, 30, 40 years ago. I might be wrong there, but the question is, we know that you're focused on ADR, but are you saying the cost segregation doesn't work on ADR or isn't allowed? Are you familiar with ADR? I don't think it's even a system in place any longer.
So ADR is called asset depreciation range. That's not a system according to which things depreciate, but it gives you a life based. The ADR is still linked back to makers and acres.
Okay.
But they give the recovery period is associated with the ADR.
Okay. So really we're under mainly makers at this point, correct?
Correct.
And so that's the system that the cost seg is based on. Okay. I'm going to close this poll, but then while I'm doing that, Harry, I'm going to leave it open while I ask you another question.
Sure.
And I don't know if we know the answer because it's state specific, and you and I will probably talk a little bit about states at the end. Yep. But do you know if California conforms with and I don't even know how to read this, REPS or REPS/material participation for taxpayers to offset passive losses with passive income? Is that?
So it's very state specific, and I'm not deemed to be a CPA expert as an expert here either. So what I would say is reps and material participation, I would assume, but whatever I pull from reps and material participation applies on the federal side. And I don't see how it would be any different from the state side, but don't quote me on this. I think the best person to answer this would be your CPA, or I can do some research on it and get back to you. But I've seen no instance in which you can offset your passive losses with active income until and unless you qualify under real estate professional status, and also you materially participating in that activity. But I don't know if California specifically conforms to it. I know federal does.
Okay. All right. Yeah, each state's hard to. We usually have to look those up state by state. But all right, thanks. And there's another. I think that's it for now. Let's move on to your presentation.
Perfect. So I get this question a lot. People, ask me, hey, does it make sense to do a cost segregation study if I'm going to end up selling the property? Short answer is no, it doesn't make sense. But the caveat is, how long are you going to hold your property for is the answer. So if the holding period is more than 3 to 5 years, given a 100% bonus, it absolutely makes sense for you to do a cost segregation study, because at the end of the 5 year, you can do evaluation in which your 5-year property that you found at the starting of the cost seg will have those assets will have little to no value. And then you can basically assign $1 or $2, what have you, and you can reduce the gain, the ordinary income tax, because everything was going to be $1,250 at that point. So you wouldn't have to pay any tax on it. But if you did a cost segregation study and you sold the asset right away, you're going to end up paying a recapture at an ordinary rate. And this is the diagram or a graph that kind of explains you. So let's consider you bought a property, let's consider whatever X amount you bought this property for minus land. The total basis was 3 million. Out of 3 million, you ended up depreciating 1.5 million. And the adjusted basis is purchase price minus land minus the depreciation taken. So adjusted basis is always the basis that is calculated. Even you include them. To keep it simple, I did not include improvements. Sometimes you will even include closing costs, selling costs, and all the improvements. I just want to keep it simple. So adjusted basis for now is 1.5. 1.5 is depreciated. 1.5 is not depreciated, not touched at all. You ended up selling that property for 4 mil. So a lot of people will think, okay, I clearly have a gain of $1 million here, right? Because you bought it for 3 million minus land and you sold it for 4 million, right? The issue here is the gain is not calculated on the purchase price and sales price, this is calculated based on the adjusted basis. So if you have 1.5 million that's depreciated, that 1.5 million that is depreciated will be the 1245 property that cost seg captured will be captured at the maximum rate, maximum ordinary rate, which will apply to you at this point is 37%, whatever your maximum ordinary rate is. That's one. Second is, if you have any 1250 recap, if you have any 1250 property, meaning, what does 1250 property means? Means that you did not do a cost seg. You bought a property, you depreciated over straight line, purchase price divided by 39 year, whatever number you get, that's 1250 property. That will be recaptured at 25%. Now, remember, there is a gain of $1 million. That gain will be taxed at a capital gains rate, which is right now maximum is 20%. So yes, so if you sell the property, you're going to end up paying a recapture of 37% on 1245. For 1250, you're going to pay 25%, and a capital gains rate, whichever the gain is, the arbitrage, right? You're going to pay 20% on the Section 1231. So there are three things: Section 1231 capital gains, Section 1245 recapture, and Section 1250 recapture. The recapture that you pay is typically to the maximum of the depreciation that you have taken, and the remaining adjusted basis obviously remains 1.5 million that is not touched. But we have a couple of questions, like, we'll talk to Randy and they'll clear up a little bit more about recapture. I hope this kind of gives you an idea as to how recapture works and, in hindsight, like how things are done. Now, the second follow-up question that people ask me is, I understand, I'm getting a recapture. What do I do to avoid this? A couple of things that you can do. Number one, you can do a 1031 exchange to a new property, given it holds up under Biden administration. And I know there are some changes going on in the, in Washington. We're thinking that if you're single, you can defer that gain up to $500,000, and if you're married, you can defer that gain to $1 million. Who knows what's going to happen? It's not a law yet, but there are some talks, right? Second, buy a new property, bonus depreciate that property, create a huge loss, and based on the CS that you did, you can offset that all the gain from the old property that you're selling. So basically, this will be passive. The passive losses, passive gain that you're getting from here, passive losses from the new cost that you're doing, you can offset it, right? But the third thing is you just hold the property for a longer time, and once the personal property is ending its taxable life, has less value left, you will move this asset to 1250, meaning you do a cost segregation study. Let's say you did a cost segregation study at the starting of this, when you bought this building. At the end of 5 years, those assets will not have 0 to less value, right? You just reallocate it, so you have just 1250 recapture, not 1245. So moving on to the next slide. Qualified improvement property. This has been a hot topic for a while now. So, and it has gone through ups and downs, and we'll talk about that. Qualified improvement property is under the Section 168E6A under the regs, Internal Revenue Code, and it was introduced under the PATH Act of 2015. And what they did was later on, they changed the definition of qualified improvement property to include any property, any Section 1250 property made by the taxpayer. Originally, when this qualified improvement property definition came out, they never had this verbiage of made by the taxpayer. So they included that, and they said that it's an improvement to an interior portion of a building, which is not residential property, if such improvement is placed into service after the date such building was placed into service. And we'll talk about it, some tax planning things that you can do in order to claim this. So, but what you'll realize though is how similar this definition is to QLI, right? So QLI had the same definition pretty much, but they also said that it should not include improvements that are attributable to enlargement of building, any elevator or escalator, any internal structural framework of the building. They had the same exact definition for QLI and QIP. But what are the differences? I get it, they're the same, but what are the differences? So now you do not need to worry about the 3-year rule after the building was originally placed into service. If you remember back in the day when you used to take QLI, I'm talking like prior to 2017, you had, let's say you bought a building and you did improvements to it, only those improvements will qualify if they were done 3 years after the original building was placed into service. Number one. Number two, the parties were not supposed to be related in order for you to get QLI. But in this scenario, you can be related parties. It doesn't really matter, right? And the third one is the improvements can be done to common areas and they don't have to be pursuant to a lease. Like they're pretty much making it so easy for people to qualify for QIP. And one kind of like a tax advisor I kind of give to people is like a golden nugget. Let's say you acquire a property a day prior to starting. So let's say you acquire property January 1st, 2022, right? And you start doing the improvements to that property and you place those improvements into service, like say January 2nd, 2022, even if it's placed after a day, you can claim those improvements as QIP. So you do not have to worry about, hey, you know, you don't have to follow the 3-year rule. But if you acquired a property in January 1st, 2022, and you place the improvements into service the same day, you cannot get QIP. So what I advise my client is sometimes what they would do is they will buy a property and they would never place the asset into service because they're doing improvements inside that property. What I'll tell them is, hey, you know, if the asset is ready for its intended purpose and use, and if it's not, you know, when you're placing the acquisition into service, place them just like, you know, have a difference. They'll place it a day before you put the improvements into service, so you can claim QIP. So that's like a loop that people can use to claim QIP. And Tax Cuts and Jobs Act consolidated qualified restaurant, retail, leasehold improvements into qualified improvement property. Going forward, you know, all those have been phased out. There's only one qualified improvement property that you can take. Now, the journey for qualified improvement property from the PAT Act to the Tax Cuts and Jobs Act to the CARES Act. So I just kind of give you the dates of when the bonus apply and what is the life. So very interesting. So if you have an asset placed into service January 1st, 2016 through December 31st, 2017, you get a 39-year life of 50% bonus, right? But now if you acquired and placed in service an asset September 28, 2017 through December 31st, 2017, you get 39-year life, but with 100% bonus. Yes, it's 100% bonus with 39-year life. But then people were expecting, hey, you know, when Tax Cuts and Jobs Act came around, the QIP, you know, will be fixed to 15-year, what it was originally supposed to be. They never did. So they did not assign 15-year, they kept it 39-year, which is also known as retail glitch. But now they even reversed the position saying that, hey, anything going forward from January 1st, 2018 to December 31st, 2019, it was 39-year life with no bonus. And then when CARES Act came around, they fixed the retail glitch, retroactively fixed it actually. And they said that any asset placed from January 1st, 2018 through December 31st, 2022 will get 15-year life with 100% bonus. So as you can see, it has gone a lot of ways, like up and down, up and down, up and down. But I hope this kind of gives you an indication of what this thing has gone through. So next slide I'm going to talk about is bonus depreciation, or also known as additional first year depreciation deduction. So bonus depreciation is under IRC regulation 168K is an additional depreciation allowance through which business owners can immediately deduct a large percentage of purchase price of any qualified property in the first year. When people think about bonus depreciation, they start to think, hey, I can get more depreciation. Yes, you can get more depreciation, but let me give you an example. It doesn't increase your basis. If you bought an asset for $2 million and you do a cost segregation study, and I ended up finding $500,000 for you for personal property, that $500,000 personal property would not be increased to $1 million because of bonus depreciation. All it does is that $500,000, you're timing that $500,000. That means that if you place that asset into service after September 27, 2017, and between December 31st, 2022, you can pretty much write off that asset with 100% bonus. That means that you can claim the $500,000 in the very first year. That's what bonus does. Bonus does not increase your basis by any means. Okay, so we have that out of the way. So which property qualifies for bonus depreciation. So makers property with a recovery period of 20 years and less, certain types of computer softwares, right? Water utility property, qualified film or television production, and qualified live theatrical production. One thing that I want to note is bonus depreciation is mandatory. If you don't want bonus depreciation, you need to elect out. And that election needs to be made out separately for each class. What do I mean by each class? When you're depreciating a property, you have property classes, 5-year, 15-year, and what have you, right? You have to elect out of each class for not claiming bonus depreciation. If you don't elect out and you fail to make an election, it will be considered an improper accounting method in which you will have to file a draft form 3115 or form 3115, and that will be filed under change of accounting method number 7 in order to fix that. So now let's talk about, let's talk about how does bonus depreciation applies to acquired properties and newly constructed properties, right? So when the laws came out, like after Tax Cuts and Jobs Act, they said that, hey, any property acquired post 9/27/2017 is qualifies for bonus depreciation. And thanks to Tax Cuts and Jobs Act, not so soon, right? There are some rules that kind of made it harder to claim bonus depreciation even on used properties, even though it's a significant thing that was never there. Made cost segregation, making people do cost segregation even more and more, because now you can do get bonus on used properties. But there are some things that you have to consider. First thing is, like, previous rules indicated that the original use had to begin with the taxpayer, meaning that if prior to Tax Cuts and Jobs Act, if you are the one who constructed the property, only then you can claim bonus. But those rules change now. Now they said that there are some implications. If you're acquiring a property and you acquired a property with a written binding contract before September 28, 2017, it does not qualify for bonus. And they specifically said that the date at which the written binding contract is enforceable is deemed acquired. When is the property acquired? I'm not going to dive much into this because we are like 5 years into this thing, and I'm hardly going to find people who are acquiring new properties that would apply to you. But there are still some rules that you need to be kind of aware of when you're acquiring a property. If it applies to you, if you have acquired a property during those time periods, you have to go through those rules, meaning that was there a written binding contract? What is the acquisition date? And the acquisition date is determined in reference to the written binding contract, which is later of the date. And there are certain clauses that you have to kind of fill in. When was the contract entered? Was the contract enforceable under the state law? When did the cancellation periods end? If all conditions and subject to contingency clauses are satisfied. If you kind of meet all these definitions, you have to kind of see what is the later of the date. If the contract date was entered, yeah, but you enter it after that date, but was it still enforceable under state law? So you have to follow those rules and see. Second thing, which a lot of practitioners kind of don't pay attention to, is when we issuing out benefit estimates to our client, we always ask them, hey, was this property used before by the taxpayer or a predecessor during a 5-year look back period, right? And we kind of have to do some, go through an education telling them, when does property deemed to be used? That pretty much means, in a summary, is if you have used the property, have a depreciable interest in that property, you cannot get bonus. You cannot buy a cake and eat it too, right? You cannot. Related party, component member of a control group, or in a transaction in which base of property in the hands of the acquirer is determined in whole or partly, or in other terms, was it acquired? Was it an inherited property? You cannot get bonus to that. Final regulations actually came back because there was a lot of confusion. People saying, when would I know if I acquired from related parties? When would I know? Like I cannot get bonus. So the final regulations came back and they started, they gave a definition of what is a predecessor and what is the 5-year rule, and they kind of defined all of those, and that we're not going to go into that this part of a different webinar. That I just want to give you like a briefly an idea of in an acquired property, there are still implications that you got to keep in mind. It's not slam dunk all the time that you can get bonus just because you acquired the property after 9/27/2017. Last thing that I wanted to mention on this one is, yes, if you acquire property, acquired and placed in service, a new property, meaning a newly constructed property, is deemed acquired and placed in service after 9/27/2017, it qualifies for bonus depreciation. If you go prior to at the timeline of 9/27/2017, there were some rules like component election. Is it a self-constructed property, more than 10% rule and whatnot. I'm not going to go into those rules because you're hardly going to find any construction that is lasting from 9/27/2017 till now. Usually construction lasts like 1 year or so. And I have my last slide now before I close it up.
Hey, Harry, before you
yes.
start this slide, I'm going to put poll number 3 up just so we spread these out a little bit.
Sure.
And so polling question 3 is about to go. I am launching it now. So get your obviously there's no right or wrong answer that you're going to be graded on. And so just get your answer in there. Harry, one thing I wanted to clarify, the question before, they didn't mean to type ADR, they meant ADS.
Oh, I see.
And so I don't know if we want to go into that at all. I may ask them to just email us the question.
Yes.
But in general, ADS is not bonus eligible. You can elect this alternative depreciation system, and you may do it in certain situations to get other benefits out of other aspects of the tax code. But in general, it's not bonus. I don't know if you want to add anything to that.
Yeah. Okay. So there is a specific rule that happened, during this prior regulations. What was happening was people were electing 163J elections, which means that they did not want to give up the benefit of expensing the interest. IRS said that, okay, you don't have to expense the interest, but if you don't have to expense the interest, guess what? You have to depreciate your longer life over ADS.
Yep.
It does not affect you, and I'll tell you how and why, because if you do a cost segregation study, your personal property does not need to move to ADS.
Okay.
But if you have a QIP, that will need to move from 15-year to 20-year and will not be deemed bonus eligible.
Okay. All right. Perfect. And I just want to tell everybody, because we only have 85% participated in this poll. There is a poll up right now, so please get your selection in, because I'm going to close it. It's been up 1.5 minutes now, so I'm about to close poll number 3, so Harry can move on. In fact, I'm closing it right now.
Perfect.
All right,
Thanks,
Harry, it's all you.
Yep. So this is the last slide that I want to talk about and I want to take this away from people. If people want to take a screenshot, you might have slides on this. Like if you have property acquired, key is acquired before 9/28/2017 and placed in service after 9/27/2017, the old phase down bonus rules apply, and you can find that under IRC section 168K8, and prior to the amendment by Tax Cuts and Jobs Act, you get 50% bonus if placed in service in 2017, 40% in 2018, 30% in 2019, 0% in 2019, and 0% after 2019. And now we are living in the era now that's after that is if you acquired and placed in service after 9/27/2017, we are like in 2022 now. So that's why I'm not focusing on the old rule that much. New bonus rules apply, in which you get 100% if you're acquiring 9/27/2017 to 12/31/2022, 80% in 2023, 60 in 2024, 40 in 2025, 20% in 2026, and bonus sunsets in 2027. I'm not saying that's going to happen. That has not happened in the past. Congress is going to do something. They're going to go back and probably fix this at some point, as they have already done it in the past, right? What I want to pay attention though, guys or folks, is if you are planning to buy some investment properties, you're planning to get more passive income, I get it. Interest rates are on the rise. Inflation is out of control. But guess what? If you place in service in this year, you're going to get 100% bonus. So you might want to have that thing in your head. If you do a cost seg, you can offset a lot of deductions. So, as inflation seems out of control, bonus depreciation is there to help you out. So just know that. And if you acquire it next year, not too bad. You still get 80%. but keep in mind, it will still help you out. So I think we already did the polling question number 3, Randy.
Yes.
So
Yep.
that was the next one.
Yep.
And
So we can skip that.
Yeah,
All right.
I'll hand it over to you now.
Okay, and I'm going to need you to
Sure.
drive the slides. So
Yes.
only a few things I want to go over here on 179D and 45L. We have done webinars on these in totality in the past, and I think there's some on our YouTube channel. But what I want to just touch on briefly, and we will do a longer one on this again. 179D is the energy efficient commercial building deduction. It is now a permanent part of the tax code, which happened in the Consolidated Appropriation Act. Next, Harry. All right, so who do you want to think about when you're thinking about 179D? There's actually 2 users of this deduction, not a credit, but a deduction. And your users are going to be commercial building owners, for the most part. Lessees can as well, but commercial building owners or designers of government buildings, because that designer can take advantage of this deduction by having it allocated to them from the government entity. So designer would be an engineer, architect, general contractor, mechanical contractor. Those are the ones you want to think of. Next one, please, Harry. And so what is this? It's very similar to what Harry was talking about for the last 45 minutes, is accelerated depreciation. But what we're doing is we're getting accelerated depreciation on a property that we can prove is more energy efficient than hypothetically it would have been in the past. So we don't have to look at bills and compare bills. It's a computer modeling system we use, and we computer model this building, see if it's more energy efficient than this point in time in the past, and if so, we can get up to $1.80 a square foot deduction. That's what this is. Now, the building owner accelerates that depreciation. The designer of the government building gets a Schedule M adjustment. They get a deduction on that tax return that is not on their books, and that's free money to them. Building owner, time value of money. Designer of a government building, free additional deduction. So that's 179D. Harry, if you want to just keep going all the way to 45L, and I'm just, oh, you know what? While we do that, while I talk 45L, I'm going to put the next poll up as well. And so we can get this last one out of the way. And poll number 4 is up currently. So while I'm talking 45L, you answer the poll. So 45L is similar to 179D in a couple aspects. One, it's based on real estate. 2, it's based on energy efficiency. 179D, commercial buildings. 45L is a credit available for designers or developers of residential property, technically low-rise residential property. And so we want to look at the client base you want to look at. And remember, poll question is up. Listen, poll question is up. We only have 81% voted on this so far, so please answer poll question 4. This is a low-rise property. What we need to do, very similar to 179D, is do a computer model, verify if these residential properties are more energy efficient than actually the time in the past we compared to as a 2006 standard. If we computer modeling shows this building is more energy efficient, this residential property, we can get $2,000 per unit credit on this. And so this developer who develops a condo with 100 units in it has a potential, if it qualifies, $200,000 tax credit. And obviously credit, we're talking about a straight reduction in taxes. I'm going to close this poll. We've been open a minute and a half. Just want to make sure if anybody wants to vote on the poll, please vote. All right, I'm closing now. All right, so with that being said, 179D, 45L, 2 incentives out there for the real estate industry. 1 for commercial buildings as a deduction, 1 for residential property as a credit. Clients you want to think of, anybody that owns a commercial building or a designer of that commercial building. 45L, low rise, 3 stories or less above ground, credit for developing residential property. And I just got a question about can you take it on the first 3 floors in a taller building? No, the entire building has to be lower than 4 stories. With that being said, I personally have to jump to my next webinar. And so polling question 4 we put up. Mark Reese is going to close us out, tell you what's coming up. if anybody on here is a CPA America Association member, you can jump over to my next webinar, which is going to be mental health awareness going beyond burnout. But if you're not, just stay here, finish up with Mark. And as always, I appreciate it, seeing everybody on this. And until next time, have a great one. Mark,
Thank
it's
you,
all
Randy.
you. Yep.
Thank you very much. Yes, we have our new set of webinar series on practice management. Our next one is June 23rd on 5 strategies that will accelerate your firm's growth. This will be presented by John Hubbard from Boomer Consulting. And we also will be setting up another webinar this June discussing R&D, and we'll have more information on that on our website. And then we've also got something lined up in August focused on pricing for improved profitability, presented by Geraldine Carter. So we've got some exciting webinars coming up. So just keep following us. And then also with our specialty tax series, of course, our R&D tax credits and R&D expense capitalization, how to comply with new IRS requirements. This one is going to be really exciting. So be sure to visit our website to sign up for that. Other than that, if you have any questions that didn't get answered, please email us at info@try-merit.com. And if you just reach out to us. And of course, thank you so much, Harry, for being able to be here with us. And of course, you can reach out to him or Randy if you have any questions. And that's pretty much it. So thank you so much for attending with us today. And we hope to see you at the next one. Thank you.